In this segment, we will look at a capital budgeting tool called the accounting rate of return. The accounting rate of return as a capital budgeting tool focuses on annual net income instead of cash flows. When we're dealing with investments in property, plant, and equipment, the difference between the investment's cash flows and its net income is one non-cash expense, and that non-cash expense is depreciation. So the formula to calculate accounting rate of return is the amount of annual after-tax net income on that investment that is expected divided by the average amount of annual investment. A rudimentary way to get the annual amount of average investment is to take the beginning book value of the investment or the equipment plus the ending book value and divide by 2. So consider a $16,000 investment that's being considered by ABC. This investment has an 8-year useful life and no salvage value. The annual cash flows are expected to be $4,100. They want us to compute the accounting rate of return. Now remember, the cash flows are only relating to cash, not non-cash expenses. So in order to evaluate the accounting rate of return, we first need to calculate the amount of net income, which will be the difference between the cash flow and the depreciation on this particular investment. So assume a straight line depreciation. Straight line depreciation is calculated by taking the cost of the investment minus any salvage value. This investment is not expected to have any salvage value, and then divide by the useful life of the asset, which is 8 years. So 16,000 minus a 0 salvage value divided by 8-year useful life. The amount of depreciation expected each year is $2,000. So the net income will be the cash flow less the depreciation, $2,100 per year. So calculating the rate of return, net income of $2,100 divide by the average investment. To get the average, we take the beginning investment amount plus the ending and divide by 2. We calculated an accounting rate of return of 26.25%. This means that this investment will provide a 26.25% on the investment amount. This accounting rate of return would then be compared to the corporation's overall required rate of return for investments that it gets involved with. It's sometimes also known as the hurdle rate. If the calculated accounting rate of return exceeds the required rate of return, the investment would be considered a good option. The accounting rate of return as a capital budgeting tool also has some shortcomings, just like the payback period. It bases the amount invested on book values, not predicted market values in future periods. The income may vary from year to year, and the time value of money is ignored.